We already know that in a simple world without any frictions, we already know from the Modigliani and Miller theorem that financial decisions made by firms would be irrelevant in the sense that they would neither create nor destroy value. So we need to incorporate frictions to incorporate why financial decisions, and in particular financing decisions, matter. A very important friction is asymmetric information. The fact that firms might have more information than investors do, or the fact, as we saw in the Grossman-Stiglitz models, that different investors will have different levels of information. Some will be, so to speak, informed, while others will be uninformed, for example. Okay, so this week we're going to study two theories of financing under asymmetric information, starting with the IPO underpricing theory, and then we'll study the pecking order theory. Okay, so first of all, let's look at the frequency distribution of IPO pricing. So as you can see, there's a pretty wide, that's a pretty wide distribution, and the returns can be extremely small in some cases and very large in other cases. So there's a pretty wide distribution, even though we're looking at very short-term returns, right? So let's start with the model of IPO underpricing and by Rock. It's actually a puzzle that IPO returns are on average so high, even though there's a pretty large dispersion. If you take the perspective of a diversified investor, you should be able to achieve this average return, right? If you buy into every IPO, you should be able to get the average IPO return, which is about 15%. So why does this very high average return persist? And it seems very puzzling. It seems that firms are leaving money on the table because they should actually be able to go public with a higher stock price, which means that they would actually raise more funding. And instead, that's not the case. And instead, their stock price goes up a lot on the first few days after they go public. So why is that the case? Okay, so to understand that, we're going to consider a simple model with different types of firms and different types of investors. But to keep everything as simple as possible, there's only going to be two types of firms and two different types of investors. Okay, so two types of firm are going to go public through an IPO, and some are going to be, so to speak, good, and others are going to be bad. And there's a proportional row of good firms, and their fundamental value is V upper bar, whereas bad firms, their fundamental value is V lower bar. Of course, V upper bar is greater than V lower bar. Now, regarding investors, there's two types of investors. So investors can be either informed or uninformed. We're going to keep things as simple as possible. So we're just going to assume that informed investors know the type of the firm. So they know whether it is good and it's worth this much, or bad and worth that much. Whereas uninformed investors do not have any information. They just know that there's a proportional row of good firms. There's a number NU of uninformed investors and a number NI of informed investors. And everyone is risk neutral, again, to keep things simple. Okay, so what is the IPO process? So when a firm issues share to the public, uninformed investors do not know whether the firm is good or bad, but informed investors would. So a firm is going to issue a number S. So S refers to supply, a number S of shares in an IPO. The shares will be issued for a stock price P. So this is the stock price at which the firm will go public. To keep things simple, we're going to assume that the supply is less than the number of uninformed investors. So the IPO is not huge. Investors are going to submit their demand to the underwriter. So the underwriter is an investment bank who's organizing the IPO, an intermediary between the firm and the investors. And the underwriter allocates shares among investors who submitted demand for the IPO. To keep things simple, demand is binary, so each investor can demand 0 or 1 shares. Okay, what is going to be very important is rationing. So what happens when demand for shares exceeds the supply S? Well, in this case, and this is actually what happens in practice. So there's going to be some rationing, because inevitably, if demand exceeds supply, you get a ration existing shares. And so we're going to assume that allocation is on a pro rata basis. Each investor gets the same fraction of what they demanded. And also, as soon as there is rationing, of course, you're going to extract some information about the firm type, because obviously rationing is going to be different for different firm types, as we are going to soon find out. There's actually two steps in this model. The first one is to determine the optimal demand from informed and uninformed investors. And the second step would be to determine what is going to be the issuance price at which a firm will go public. Okay, so let's start with the optimal demand. So for an uninformed investor, this uninformed investor does not know the firm type. Okay, so their optimal demand will always be the same. It's either going to be 0 or it's going to be 1. So here we're going to assume that there's not enough informed investors, so the firm is also trying to attract uninformed investors. Okay, so in such a way that uninformed investors will always have a demand of 1. Okay. Now, from the perspective of informed investors, so these ones, they can discriminate, right? Because they have some information. And so if the firm is bad, they're going to demand 0. And if the firm is good, they're going to demand 1. Now, remember, a good firm is worth this much, and a bad firm is worth that much. And informed investors, they know the type of firm. Okay, so it's actually very simple to derive the optimal demands. Now, what's a bit more interesting is now to determine what is the issuance price. And so here, as I mentioned, the underwriter wants to ensure the participation of uninformed investors. So, for example, because there's not enough informed investors for the IPO. But when are uninformed investors going to participate? They're going to participate when they are going to at least break even. Okay, so the price would be set at the level such that uninformed investors break even. And this is this break-even condition. Okay, so what are the outcomes from the perspective of uninformed investors? Well, with probability rho, the firm has a good type, so its value is worth this much. So when informed investors submit a demand of 1, and they get a share, well, the firm is worth this much. So this is what they own in their portfolio, but they paid the price P to purchase this share. In addition, so this is probability rho. So when the firm type is good, what is going to be the total demand for shares? Well, all uninformed investors are going to demand shares, and also all informed investors are going to demand shares, right? So the total demand for shares is going to be Ni plus Nu. Total supply is fixed, is simply a capital S. Okay. So then there's going to be some rationing. Okay. This whole thing here is less than 1. Simply because of this assumption. So if you demanded 1 share, you're going to get less than 1 share. You're going to get only this many shares when the firm is good. You participated in the IPO as an investor. Okay. Now with probability 1 minus rho, the firm is bad, and so its value is this, V lower bar. And likewise, you still pay the same price, and this is the IPO price. It's the same regardless of the firm type. You paid the price P. Okay. Again, it's going to be some rationing because S is less than Nu. But as you can see here, this term here is going to be greater than this term there. So there's going to be less rationing when the firm type is bad. Okay. And so this is the expected profits of uninformed investors. And in expectation, so expected profits must be equal to 0, so that they break even. So we can rearrange this. So what are we trying to determine here? We're trying to determine what is the issuance price set so that uninformed investors are happy to participate in the IPO. Okay, so we rearrange this equation. We solve for the price. And we find that the price P, the issuance price P, is equal to this. We can again rearrange this to simply write the issuance price P as a weighted average of the value of a good firm and a bad firm. But what's interesting is that if you look at the weighted average, the issuance price is going to overweight the value of a bad firm because this term here is larger than that term there. Okay, so think about it. If the issuance price is going to overweight the value of a bad firm, the issuance price will be pretty low. So it means that firms are going to issue shares at a discount, at a pretty low issuance price. This in turn would lead to pretty high expected returns on average, right? So that would be consistent with the pretty high returns that are observed following IPOs. But if you take the perspective of uninformed investors, these uninformed investors still make zero expected profits, right? So why is that? Well, it's simply because in an IPO, when the IPO is bad, there's not going to be much rationing. So they're going to get lots of shares out of their demand. But when the IPO is good, when a good firm is going public, there's going to be a lot of rationing. They are not going to get many shares. So they're still going to make a profit, but out of a pretty small share allocation, because rationing was especially strong when the firm is good. And in turn, this is because when a firm is good, there's a lot of demand from this firm's shares, okay? So it's precisely this different rationing, depending on the firm type, that is going to lead to uninformed investors mostly getting shares in bad firms. And in order for them to break even, the issuance price must be pretty low. But now if we take the perspective of an analyst, a financial analyst or a researcher, and we just observe IPO returns, so what are they going to be? With priority row, the firm is good, its value is equal to this, so its stock price will converge to this level as soon as the firm type becomes known. It's going to be the stock price return for a good firm. This is a probability the firm is bad. This is going to be the stock price return for a bad firm. We just rearrange this. And given the expression for the price that we had on the previous slide, we can show that this whole expression is strictly greater than 0%. Okay, so there's going to be a positive return to IPOs, even though from the perspective of uninformed investors, they're just going to break even. Their expected return is going to be 0. Now they're still going to have a positive return whenever they get shares in a good firm and a negative return whenever they get shares in a bad firm. But in expectation, their return is 0. This positive return, which is greater than 0%, that would correspond to this positive return that we observe here. So when would the average IPO return be 0? It would be 0 if the issuance price was just the expected firm value. But it is not, right? We know that the issuance price is equal to this, which overweighs bad firm because there is less rationing for bad firms compared to good firms. Okay, and in turn, this is necessary to ensure the participation of uninformed investors. All right, so with this very simple model, and there's only 2 types of investors, 2 types of firms, we can actually explain why the average IPO return will be positive. At the same time, there's no arbitrage, right? There's no simple arbitrage strategy of buying into all the IPOs and getting this return. If you are an uninformed investor, you are not getting this 15% return, you are getting an expectation a return of 0. Okay. And so what is crucial is not that there's rationing per se. If rationing were the same for good firms and for bad firms, we would still get that the IPO price would be equal to this. And so here what is crucial is that there's more rationing for good firms than for bad firms. Okay, and one last question. So what is the average IPO return for informed investors? So if you take the perspective of informed investors, these ones are only going to invest in the firm when the type is good, when the firm type is good. When the firm type is bad, they do not demand any shares. So from their perspective, an IPO will have a return of this for sure. Okay, and this return is obviously positive because P is the weighted average of V upper bar and V lower bar. So it's lower than V upper bar. And so this is going to be strictly positive. Okay. So in summary, the average IPO return is going to be strictly positive. The return of an IPO from the perspective of informed investors is going to be positive, but the return of an IPO from the perspective of uninformed investors is going to be 0 on average.